Now for a look at the global market space, I'm joined in Cape Town by John Orford. He's the portfolio manager, Old Mutual Investment Group. A very good afternoon to you, John. Well, looking at the markets, resources under a lot of pressure today, down over 6%.
Yeah, it's been a very tough day today, and really just carrying on the trend in resources which are really under a lot of pressure due to the weaker demand out of China on the one hand, the big supply ramp-ups we've seen in particularly iron ore, and obviously in oil, the unwillingness of OPEC to actually cut production despite the low prices. And then obviously, as you mentioned, you've got the Fed likely to raise rates, and the dollar has been pretty rampant over the last while, which is typically bad news for commodity prices.
A stronger dollar, also bad news for the rand. The rand at 14.67. More pressure, like you say, to still come through for the local currency.
I think when you look at the valuation of the rand, or the rand level compared to history, it certainly does start to screen up as pretty cheap on a number of measures. The problem with the rand is that the fundamental drivers are all still pretty negative. So if you look at the things that we export from South Africa, we're exporting less of them in volume terms. That we saw that again today in the current account deficit data. And also the price of many of the goods that we export are much lower. So while some of our import prices are down, the oil price is down significantly, iron ore, platinum, gold to a less extent, all down as well. So we're getting less revenue as a country. But on the import side, the demand is actually holding out reasonably well. And what we've seen in the last couple of months, which would suggest that Q4 is going to be worse than Q3, is that the trade deficit has widened again. So there's still pressure coming through, and the rand is not yet slowing down imports enough, given how much our exports are under pressure.
So what's the next level for the rand?
Well, obviously it's difficult to say, but I think in the near term at least, the forces acting on the rand are probably likely to drive it weaker. What could work for the rand is that once the Fed does hike, and if there is a signal from the Fed that it's likely to be a fairly modest cycle, we may well see a breather in the dollar's strength if people begin to trace back the amount of tightening that we're likely to get, particularly with the ECB having disappointed a little last week in terms of further stimulus. So that may provide some respite into the new year, but I think we also need to do some things right here. So we have the opportunity in the budget next year to signal a strong commitment to fiscal prudence, which would begin to improve some of the domestic factors that we can actually control.
And talking about that budget next year, we know that credit ratings agencies will be watching the finance minister and how he looks at the country's finances. But let's look at Anglo American coming out with a statement today that it will cut its dividend for 2016, also looking to cut its workforce. Would you say that was expected?
Yes, I think the market's been anticipating that Anglos couldn't afford to pay a dividend the remainder of the 2015 year and into next year, so that was widely expected. And I also think looking forward, they're moving towards a payout ratio-based dividend, so really bringing their dividends in line with what they're earning, which is pretty cyclical given that they're a commodity company. So that's probably a more sensible strategy to move towards. The other measures that they announced were further CapEx costs, the reiteration of their sales target, as well as some cost savings, streamlining their business into three main groups, all aimed at preserving cash flow in an environment where the price of the goods and the demand for their goods are down, and that's putting pressure on their balance sheet. So I think the dividend cut was very well anticipated.
Looking at the commodity space or the commodity companies at this stage, is this a sector that you're playing in? We've been fairly cautious on the sector as a whole.
and overall, I would say, on South African equities for some time. So we've run a pretty underweight position. So our overall exposure to the sector has been pretty small, which has been good. Obviously, as these prices fall down, there will be a point where we would want to get more involved in the sector again. But clearly, I think to get confidence about that over sort of a longer term view, one needs to see demand out of China stabilizing and the Chinese economy picking up a little bit. And we also need to see signs that supply is being cut back, particularly in iron ore and energy, where excess supply is clearly a factor. I think in South African mines as well, they're hampered by South African specific constraints, which really push up costs. And we've seen that across the board in South African mining. But today, Kumba also announcing measures to reduce production and try and improve their cost structure in Kumba, which will bring them to a break-even price of around about $40 per ton, but will probably still leave them looking quite expensive versus the global tier 1 iron ore producers, which produce much more cheaply. So that's a specific challenge for South African miners.
Well, you touched on China a little earlier, and looking at the numbers out of China, the trade figures, we saw exports are falling for the 5th straight month. But when you look at imports, seems like the pace of decline is slowing there.
Yeah, that's probably true. And I think that with the measures that have been pushed through in terms of interest rate cuts, some measures in the property market and so on, we'd expect a stabilization in the Chinese data, and even perhaps in the near term a bit of a bounce in that data. That said, China's growth rate has slowed from levels of closer to 12% before the financial crisis and then immediately in the aftermath, to a rate which is probably running in the region of 6.5% to 7%, and may even slow down a bit more as China shifts from an investment-driven economy towards a more consumption-driven economy where investment plays a lesser role. And that's clearly been very bad news for commodity prices. So stabilization is probably the best we can hope for out of China.
Well, we'll have to leave it there. Thank you so much for joining us, John. That was John Orford, Portfolio Manager at Old Mutual Investment Group.